Hey, 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 welcome to Credit Makes Sense with Netiva, the Frugal CrediTnista. For those of you who aren't familiar with me, I am a certified credit counselor, financial educator, and coach, and I help consumers just like you to achieve massive financial transformations, mastering your money, destroying your debt, soaring your credit scores so you can build the solid financial foundation that you need in order to begin creating wealth for yourself. So today we're going to talk about a topic that I get asked quite a bit, almost as much as student loans and collections, and that's if I have late payments, will I be able to get approved for a mortgage? And the answer is it honestly depends. It depends on what type of loan you're applying for, FHA, conventional financing, or VA, or even USDA. It depends on how long ago you were late. So if you were late on like 3 years ago, that's not going to be like a major concern to a lender. But if you were late like 3 months ago, then that's definitely something that's not only going to affect your credit score, but it's also going to not look as, you're not going to look as strong as of a buyer. You're going to look more risky to a lender. Then it's how many times were you late? If it's more recent. So was it just one isolated incident or two, or are you like in arrears with multiple late payments? So the difference between a late payment and arrears is that a late payment means you were late, maybe once or twice, right? In arrears, and you brought it current. Okay, let me put that. So it's you were late and then you brought it current. And arrears mean that you were consistently late and now you no longer owe the minimum monthly payments that you have. So let's say you have a minimum monthly payment on an account that's like $35. It's your minimum monthly payments. But since you were behind or late, that's another word for arrears, behind, you now owe $250 in order to bring it current. So that's the difference between a late payment, you brought it back current, and in arrears, you're behind, and now you owe more in order to bring it current. So that's a huge factor as well. And then what type of account you were late on. Is it like a utility bill, your rent payments, a credit card, like an unsecured debt, or another mortgage payment, or a car note, or something that's secured by an asset? What do I mean by that? A house loan or a mortgage loan is secured by the house. A car loan is secured by the car. So the FICO mortgage score is more sensitive to how you handle other mortgage accounts. So if you were late within the past 12 months on a mortgage, you can forget it. You need to wait. If you were late on a car, you may be able to get around it, but FICO is going to look at installment accounts a little bit more, a little bit more than like a credit card or a utility bill that doesn't even report to your credit report. So just keep that in mind. That's a huge factor as well. So I have some notes here, just some things that you want to consider if you have a late payment on your account and what to do. So I'm going to give you some walking tips and just to help you make your decision as you prepare for home ownership. If you're in my Claim My Keys home buying intensive or my EPIC rent to home program, all of this is mapped out to you in the 12 weeks that you're with me in the rent to home program. So like you're good. You got all of this information and then some action steps, some budgeting steps, some debt payoff steps, and also some credit building tips as well. But for the sake of this video, I'll give you a roundabout tips and suggestions and information so that it can help you and empower your next steps as you plan to claim the keys to your new home. So let's get started. Let's talk about FHA. Most of my buyers do go FHA. When I mean most of my buyers, most of my clients that I coach with or that are members of my Credit on Fire membership or students of my Rent to Home and Claim My Keys home buying intensive. And the reason why is because FHA is a lot more forgiving as well as VA than conventional financing or even USDA. And so if you know you have a few credit situations such as late payments or maybe charge-offs or collections and things of that sort, then you want to choose a loan type that's going to match where you are now. So it's not like going to a lender, let them tell me what I can get. It's really looking at your financial picture, looking at the different requirements for each loan type, FHA, USDA, Fannie Mae, Freddie Mac. Those are conventional giants in the conventional mortgage industry. And then if you're a veteran, VA. So you want to look at each one and see which one will be able to give you the higher chances of getting those keys, right? So FHA usually is a lot more lenient. So with FHA, they look at if you had a late or missed payments in the past 12 months. So if it was like 24 months ago, 3 years ago, no biggie. But if you're talking anytime within the past 12 months, then it's going to depend on a couple of things. Number one, if it was just a 30-day late and you get an automated approval in the lender's automated underwriting system, then you're good. So let me kind of backtrack. So when a lender puts your information into their system, it's going to pop out either underwriting approved, approved with conditions, a couple of other things, but basically you're approved with conditions, or we need to send you to manual underwriting. So if you usually can get an automated underwriting system approval with one late payment within the past 12 months if the other areas of your application, meaning the other supporting financial information, is on point. I won't say usually, sometimes, and I'll give you some tips on that. If you have 2 or more late payments, a 90-day late payment, or it's been on a mortgage like that, like you have to automatically, don't even matter if you got an automatic approval based on everything else, but just on that, it's going to automatically downgrade you and you have to get manually underwritten. A manual underwritten approval process is when an individual, an underwriter, goes over every single piece of your financial information that you put on your application, and they're going to go through it with a fine-tooth comb. The reason why your realtor, your loan officer, and you do not want manually underwritten process with getting approved for your loan is because a lot of times we get more denials. Just because, like I said, they literally go through everything with a fine-tooth comb. I'm not sure, I won't say they're looking for a denial, but I would say that they are looking to see if you're worth the risk of lending to. So it's either going to be a denial based on the loan type that you're going for, a denial based on your down payment. So it could be we can't get you approved for a 3.5% down payment, but if you're willing to come to the table with 10%, 20%, we got you. So that's usually what we experience on the service end, real estate agents and loan officers, when our clients get manually underwritten based on some credit or other issues. So just that little bit of information. With the VA, because some of you have written me about VA and late payments as well. Actually, if you only have one late payment, you're good. Anything over that within the past 12 months, they usually, it's at the discretion of the loan officer or the lending and their overall guidelines. And in most cases, they're going to deny you. And this is one of the number one reasons why I often tell people who have a late payment to just wait 12 months from that last missed payment and do everything in your power to continue working on increasing your credit, continue working on reducing your debts, and don't miss any more payments. Get your budget on big time, okay? You cannot miss any more payments. And the reason why you have to think about this, most of the students and clients of mine who have missed payments have done so really due to not being organized and just poor payment habits, okay? Poor financial habits. And so we're asking a lender who wants to lend us something for 15 to 30 years, over 6 figures, okay, and we can't even manage something that's 4 figures, some cases like $1,000, or 5 figures, like in regards to a car. So that's a lot that we're asking of them. And so they want to be a little bit careful in who they lend to, because basically they make their money over time with you making those interest payments. So they want their money and they want it on time. So something to think about. So let's go into the next section here. So one of the questions that I got asked before was, how can I increase my chances of getting an automated approval in the underwriting system, the automated underwriting system? So other than having your credit on point and low debt income ratios and all of that good stuff, you want to be able to prove, if you have a late payment, that this was based on some extenuating circumstance, or that you have recovered from whatever period of bad credit situation that you were going on. And then you're going to have to document that with a letter of explanation and any other information that the lender may be able to request from you. So you're really just going to be required to submit a lot of information. So if you ever heard a buyer that says, oh, the process was fairly smooth, everything was good to go, that means that more than likely they had a quick automated approval, meaning that, everything's legit, good to go, you're good, you just got to submit, boom, 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 you're done. Enjoy your house shopping experience, right? But if you had somebody that said, oh my God, I had to submit everything, it was crazy, usually that means something was going on either with the debt or the credit, payment history and all of that good stuff. So the lender is requiring more information and more information and more information to really determine if you're worth the risk of giving the money to. So again, they have to, the loan officer will come to you and say, okay, well now we got to prove that the situation was an anomaly. basically. It's just not something that's going to happen over and over again, and your credit is going to prove whether you're good at paying stuff on time. So again, isolated payments. So the best way that you can get the automated approval again is to ensure that A, your credit is in point, B, your debt to income ratio is good, and C, I would definitely wait 12 months after your last late payment. So can you get approved? You can. Is it going to be a quick, easy, such and such process? No. If you want me to be real, no. So let me also go over just some quick tips that I had left on some variances. So one of the things that I mentioned is that with FHA and even conventional, you can purchase with a late payment, but it's going to depend on the lender. So there's minimum guidelines that FHA, USDA, VA, and all of the other loan types put out, and those are just what it is, minimum guidelines. But since they're just insuring the loan, the lender is actually giving you the funds or the note for the loan, they're going to have even more guidelines because they're taking on a lot of risk. So they may say, well, yeah, FHA may let you buy with this 130-day late, but that's not what we do. So you're going to basically be denied until you get your stuff together. I have had students who told me that a lender has basically said that and it left totally discouraged and no outlook. And so that's one of the reasons why they come to my Credit on Fire membership, or they take my Claim My Keys home buying intensive, because they want to know how never to let a lender or somebody else outside of their household be in control of their future, their finances, and their financial decisions. I applaud that. That's beautiful. So let me go over some things that I wrote out just on some tips for you guys. Okay, so when you are coming up against either a late payment, a collection, charge off, or maybe a repo or anything like that, any negative information on your credit reports, like I mentioned, it's going to be how long ago it was, how often did it happen, the type of debt that it was on, and something called compensating factors. So if you have a 30-day late payment, but your scores are over 30-day late payment within the past 12 months, but your scores are over like 650 or 680, but your debt to income ratio is like 35%. But you have maybe 12 months of your future mortgage payments saved, then they're going to say, okay, well, this is a strong borrower. So that 30-day late or even 60-day late was an anomaly, because otherwise they're a very strong borrower. So that's what I mean by compensating factors. Those strong attributes compensate for the fact that you do have this thing wrong with your credit, right? But if you're coming in with like a 600 credit score, you need a down payment assistance program, not too many assets, not too many savings, and your debt to income ratio is hitting the threshold at like 50%, then you're definitely a larger risk, and you're going to increase the chances of you being denied. So if you are one of the people who have like a 30-day late or a 60-day late within the past 12 months, then I will be working extremely hard to increase your credit scores, extremely hard to destroy your debts, and extremely hard to work on ensuring that you basically never are late again. That's pretty much what you want to prove to the lender. So one of the things that a loan officer was able to do, this was at a community lender, was to add some things to their credit report in order to make them appear to be a stronger borrower. And I do know that a lot of community banks do this, and Move Mortgage did this for another student of mine. And basically that means that they've built them a stronger credit profile and using FICO's expansion scoring model. And basically what that means is they're taking 12 months of the rental income. This client actually had 21 months of positive on-time rental income that they proved with their bank statements, and also a letter from the property management firm, and they were able to add that positive payment history onto their credit reports. They were also able to use their cable and cell phone and another utility bill to basically build a stronger credit profile. So that definitely worked, and they had probably about 6 months of savings worked out, and they had a 648 credit score. And so they actually had 2 late payments, and it worked in their favor. And they also had to do a letter of explanation explaining why it went late, and their loan officer helped them to do that. But you can Google a letter of explanation and kind of put the pieces together. They didn't have any inquiries within the past 12 months. The FICO scoring model that's for mortgage companies, it's called the Mortgage Industry Options FICO score. That one is very sensitive to high debts, to high credit card debts in particular, to inquiries, and I explain a lot more in the Claim My Keys Home Buying Intensive. I'll leave you the link underneath this video. That one is very sensitive to the inquiries. Even I had to do a lot of explanation of why we had inquiries associated with the car that we purchased, because we end up just using another method to finance it. So, I mean, it's just very sensitive to it. So the fact that they had not applied for anything in the past 12 months added to, it made them more, strengthened them as a buyer. It made them less risky. And just remember that the older your stuff, the better. So they actually had an older charge-off that was coming up on 6 years, a recent late payment, but, you know, again, they built them a stronger profile. So I say all that to say, you not only want to look at the loan type, the age, and all the other attributes that I mentioned, but you also want to look for the right lender, because every lender is not going to know what to do if you have any derogatory information. So if you have a charge-off, if you have a collection, if you have a late payment, they're just automatically going to tell you no. I actually did a live last week on student loans and collection, and I'll leave the link under this video as well from our YouTube partners, so you guys can review that on my Facebook business page. But just really knowing the type of lender to work with you is gravy. So if you know you have like some derogatory information and you may need to go VA or FHA, which are pretty much neck to neck in their requirements, FHAs can sometimes be a little bit more lenient. Even as a veteran, you want to check out both options. Yes, I have my VA loan, but a VA lender, or if a requirement under VA is saying this, then FHA is a little bit more lenient. I may have to go FHA if I want this house. And I have had a few veterans do that. If you are needing to increase your debt to income ratio, because there is like a max that you can go up to with conventional, it's usually around 50%. And you know, the FHA goes up to 56% and gives you that cushion and is more lenient towards some other credit situations, then you know conventional is not going to be for you. And don't let a lender talk you into that. This is why it's so important for us to be educated, at least on the basics of the guidelines. And guess what all this information is, honey? Google. Google. So I always get the answers. What do I do to get approved for a home? Oh, go sit in front of a loan officer. Like, you don't even know if that loan officer offers a program that you need in order to get approved. Your first step is to do your own research. Not only to do your own research, but also to look at your financial situation and see how it matches. So if you know, okay, right now my credit score is 618. I know in order to get an automated approval, I need to be, you know, about 640. What can I do to raise it up to 640? I'll calculate my debt to income ratio. That's looking at my income and comparing it to my fixed monthly debts. That's my gross monthly income, fixed monthly expenses. And, you know, right now I'm at, I don't know, 62%. I know that if I want a smooth process to get into that underwriting, automated underwriting system, get an approval in there, then I probably need to bring it down to like, you know, 40, 45-ish. Okay, now I need to know, I need to work on that. So you're kind of giving yourself your own blueprint. And then once you've done kind of the preliminary information and research based on where you are now, what loan type will work for you, then you go and talk to a loan officer, because most loan officers are only trained how to approve people based on the lender that they work for. That's it. The lender that they work for. So they may not know about other programs. And if they have additional requirements, you're missing out on another lender that does not have those additional requirements. There's even lenders who have no overlay requirements. That means that those minimum monthly guidelines that we talked about, they say, okay, well, if FHA says that, boom, we're going to approve you based on those guidelines. Like, you may need that. And so it's good to educate yourself about it. And that's one of the reasons why I created the Home Buying Intensive, which is a 10-day home buying intensive, where I teach you how to claim your keys and basically get structured and formulate your action plan to claim the keys to your new home. And then if you're looking for that next step, which literally goes over 12 weeks, where we break down the underwriting process, where we break down repairing your credit, budgeting for home ownership, eliminating your debt, the home buying process, what to do after you claim those keys, the inspection process, like the works. It's like 12 weeks of just super dope information. I'm going to leave the link, so you're going to have a lot of links below on all of that, so that you can take advantage of the knowledge if you are in fact looking to claim your keys. If you found this information helpful, definitely share it out. Hopefully you'll rock out with me in the future by subscribing. Thank you so much. And remember to click on the links below. I'd love to hear you guys' comments as well. Bye.